DocuSign just announced their Q4 earnings today, and after the earnings, the stock is down 2.62%, but before the earnings, it was also down 1.9%. In the past year, the stock is down 34%, but if you look even further than that, you can see that during the peak of the pandemic, the stock was at $300, and now it has gotten to a level where it's been at even lower than 2020, where it was at $83. So has it finally bottomed, and is this the perfect time to buy this company? We can see that on Seeking Alpha, they are using non-GAAP numbers. So they have a PE of 34, but when you go on Yahoo Finance, you can see that they have no PE. And this is because they are using GAAP numbers in Yahoo Finance. And typically it is better to use GAAP numbers because those are general accounting principles that every company uses. And from a GAAP perspective, this company is not profitable. Before we get into the video, if you like this video, like the video and subscribe for more content because we are a smaller channel and each subscription does help out a lot. Some news about DocuSign, you can see that they have done layoffs like a lot of tech companies. So in their most recent round, which they announced a few weeks ago, they are cutting 10% of their staff. And this is actually the second round of cuts because in September 2022, they had also cut 9% of their staff there. So we'll see when we get into the earnings, they actually had their first GAAP earnings that were positive. And that's actually huge. And I don't see a lot of headlines that are highlighting that. So hopefully with these cuts, they'll be profitable every quarter and they'll have a whole year where they're GAAP profitable. And this is good news for shareholders. Of course, for the people working, it's not good news, but for shareholders, we do want to see cost cuts and GAAP profitability. Getting into the earnings, we can see that DocuSign had beat the expectations. So they had a Q4 non-GAAP earnings per share of 65 cents, which was higher by 13 cents. And the revenue also beat the expectations by $20 million. The subscription revenue was up 14% year over year, but the professional services was down 5%. And I'll show when we get into the earnings that they actually lose money on professional services. So it's not too bad that they're actually losing money here. So I'm not too worried about that. The shares are down 3.7%. And mainly, I think the reason why it has gone down is because the CFO is stepping down this year, so they have to search for a new CFO, and likely that's what's causing the shares to go down. Getting into the earnings, we can see that the total revenue, like the headline, was up 14%, and the subscription revenue was up 14%, while the professional services was down 5%. And we can see that the billings had increased 10% year over year. And the margins has also gone up from a GAAP perspective, where the gross margin was 79% compared to 77% in the previous year. And GAAP net income was actually positive. So they had made 2 cents, while before they had lost 15 cents. So this is a good news. It's a very small profit, but any profit is good that the company is finally doing cost cuts and getting GAAP profitable. And from a non-GAAP perspective, we can see similar to the headline, it was 65 cents. We can see that from a net cash provided by operating activities, it has increased to 137.1 million compared to 87.8 million in the previous year. And the free cash flow was 113 million compared to 70.3 million in the previous year. We also see that they have provided outlook. So the total revenue is expected to be between 639 million to 643 million. And the consensus estimates was 640 million. So this is beating the expectations. And from a high level, these results do look pretty good. Getting into the income statement, we can see that they have very good gross profits of 522 million on 659 million in total revenue. And that's really what is attractive about a lot of these cloud-based subscription companies. But when we look at the operating expenses, we also see actually a pretty good picture here where they had increased by around $110 million. And the costs have from an operating expense has gone only up $50 million. So that is a good sign that this number is going down over time. And this is actually causing a net income of 2 cents, where before they were always not profitable. And hopefully with the additional layoffs that they're doing, the GAAP profitability is going to be even higher in the coming quarters, and they'll have a whole year where they're GAAP profitable, because a lot of investors do get into companies that are GAAP profitability. And I think over time, if they can do that, the stock price can go up over time. And then looking at the balance sheet, we see that it is pretty good here. They have increased their total assets from 2.5 billion to 3 billion, but it's not the cleanest balance sheet, I will say, because they do have a lot of liabilities at $2.4 billion. A lot of cloud companies have cleaner balance sheets than this, but there's still nothing to worry about from this company ever going bankrupt, because they do have more assets than liabilities, and they have plenty of cash as well. They have 721 million in cash, and when you add the investments as well, it's around $1 billion in cash that they can use very quickly. This should be plenty of run room, and they're actually doing a share buyback as well, which I'll show when we get into the cash flow statement. Getting into the cash flow statement, we can see that they had a positive net income, which is a lot better than the previous year where they weren't profitable. And then once you add back in the huge stock-based compensation expense of $145 million, which is very common in a lot of tech companies where they do issue a lot of shares, we can see that they have a net cash from operating activities of $137 million. And they're actually doing a buyback right now. So they're buying back 131 million in shares. So even though they are issuing a stock-based compensation of $145 million, you're not getting too diluted as a shareholder. So it's only $14 million extra in shares, which is still not the best situation, but at least they aren't issuing so many shares that you're going to get diluted like crazy, like some other companies. And then once we get all the way down, we can see that they have a cash equivalent that has increased to $723 million from 509 in the previous year. Getting into the technical segment, we can see that during the pandemic, it had the huge run up to $300, and all those gains has been given up, and it's actually trading at a value even lower than February 2022 because it was at $87 at that time. But if you look at the 6-month chart, it's actually setting up really nicely because it's on an uptrend where every single set of highs is set by a even higher set of highs, and the lows are higher sets of lows. I do think that this trend is still intact, and this is actually a very nice time to buy because in the after hours it has got down to $61 and it's right at this level, and I anticipate that there is a lot of upside. It can get up to 71 or it could get all the way up to 66. I would put a stop loss on this company if you are to buy shares right now at probably at 58 or 57, because that does mean if it reaches that level, this upward trend is no longer there. And that means it will probably go all the way down to the lows of $40. And that would be the time I would be picking up the stock. So just to summarize, I think the earnings are very good on this company. And from a technical perspective, it does look like a perfect time to buy. So actually, I am a buyer of this company at this time. I would put that stop loss, like I said, at around 57 and sell shares, because if it breaches that level, it would probably get down to like 40. So that's basically my analysis. If you like the video and subscribe for more videos in the future. Thank you.